Welcome to Delphos Insights.
It's good to be here.
So today we are looking at the investment map. And I don't just mean a map of, borders, but the actual map of returns.
It's a good way to put it.
We're sitting here in 2026, and if you're an allocator looking at developed markets, the US, Western Europe, you're probably sensing a shift. The air feels different.
It does. The space is getting crowded, and the margins are definitely compressing.
And that compression, it feels like the key word here.
It is. I mean, we're seeing these shifting inflation expectations that just won't seem to settle down, and frankly, a very different monetary policy signal coming out of both the Federal Reserve and
the European Central Bank.
And the ECB, exactly. The whole era of, let's call it easy beta, where you could just buy the index and assume a certain level of growth, that feels like a chapter from a history book right now.
Which, of course, forces the pivot. Capital is fluid. It has to find yield somewhere. And increasingly, what we're seeing is that global investors are turning to emerging markets.
They are, but not just for simple diversification anymore. It's for resilience and real growth.
We have to be really clear. This is not the emerging markets trade of, say, 10 years ago.
Not at all. The old playbook was, relatively simple. You bought a broad index fund, maybe you bet on a commodity supercycle, and just, hoped for the best.
That strategy just doesn't work in 2026.
It doesn't. Today, the returns are being driven by deep structural shifts, not just those cyclical tides we used to ride.
So for our deep dive today, we're breaking this down into what we're calling the 5 forces. These are 5 specific and I think interrelated dynamics that are shaping EM returns through the rest of this year and into 2027.
And that first one might be the most, let's say, controversial for free market purists.
We're calling it industrial policy and state-led investment.
It really challenges the orthodoxy of the last 30 years, doesn't it?
Yeah.
The prevailing wisdom was that the free market decides where capital goes. Governments just need to stay out of the way.
Right, but looking at the data for 2026, that narrative feels incomplete.
It's very incomplete. We have entered the era of what you might call the guided hand. Central banks, governments in emerging economies, they're taking really active roles in economic planning, in industrial coordination, even in labor markets.
So the government is no longer just the referee on the sidelines. They're a player on the field.
In many cases, they're the captain of the team. I mean, just look at Asia. The robust growth we are seeing in semiconductor manufacturing there is not an accident.
It's not just the market finding an opportunity.
Not at all. It is driven by very specific industrial policies and what's being called strategic reshoring. Governments decided that owning a piece of that high-tech supply chain was a matter of national security.
And economic survival.
And economic survival. So they created the conditions to make it happen.
And private capital followed that signal.
Private capital always follows certainty. When the state signals a clear long-term commitment, it effectively de-risks the entire sector for private investors.
We saw something similar in sub-Saharan Africa, didn't we? Back in 2023.
We did. There was that notable increase in private sector participation in infrastructure. Now, that didn't happen because building bridges suddenly became easier. It happened because the policy frameworks finally improved to allow for it.
And it's interesting because this also applies directly to the energy transition.
Absolutely. You have multilateral development banks, government-backed initiatives, all essentially underwriting the renewable energy expansion in these markets.
So the investor takeaway is, you need to be aligned with the government's plan.
That's the core of it. You have to ask, does my capital align with the national blueprint? Because if you're swimming with the current of industrial policy and also aligning with global ESG criteria, you have a powerful structural tailwind behind you.
That's a perfect lead-in to the tools these nations are using to compete. This creates our second force. Digital infrastructure 2.0.
And that 2.0 is the crucial part.
Right, because for a long time, the digital story in emerging markets was all about consumer apps.
It was the consumer layer. Ride sharing, food delivery, fintech wallets. And that was important. It was phase 1. But phase 2 is the B2B digital backbone.
So we're moving from simple connectivity to something more foundational.
We are. We're talking about the actual hardware required to run a modern economy. Things like localized data centers, 5G-ready platforms, high-capacity fiber networks, and cloud services.
Okay, but why the shift now? Why is the smart money moving from the app on the phone to the server in the basement, so to speak?
It's the workload. These markets are adopting artificial intelligence and industrial automation at an incredible pace. You just can't run an AI workload for a factory in Jakarta on a server that's sitting in California.
The latency would make it impossible.
The latency, for one, but even more importantly, there are major regulatory reasons you can't do that anymore.
And this gets to the concept of data sovereignty.
Data sovereignty is the big complication in the story. It's the new reality. Governments are increasingly asserting that data generated within their borders must stay within their borders.
So all that data on citizen health or industrial schematics.
Exactly. It has to stay local. We're seeing data localization laws tightening everywhere.
So this idea of a single borderless global cloud is, well, it's fading.
It's becoming fragmented, and this heavily impacts cross-border capital flows. If you're an institutional investor, you can't just buy a U.S. tech stock and assume you have exposure to global growth anymore.
You need to invest in the physical infrastructure inside these countries.
You do. You need to own the platforms that are compliant with local data privacy laws.
And the scale of this build-out, it must be significant if every region needs its own localized compute power.
It's massive. Global data center capacity is expanding at double-digit rates. And then you have to consider the Internet of Things, IoT. We're expecting tens of billions of connected devices by the end of the decade.
That's a tsunami of data.
It is a tsunami of data that needs to be processed locally. So the digital infrastructure 2.0 trade is really about owning the pipes and the storage for all of that data.
But running all those data centers, powering those new factories, it requires a huge amount of energy, and building them requires materials. This leads us directly to the third force: sustainable resources and the green premium.
Yes, and this is where sustainable investing really moves from a nice to have ESG metric to a hard financial one.
So when we talk about a green premium, what do we mean exactly?
We mean that assets aligning with the energy transition, specifically around water, agriculture, and what we call transition minerals, are starting to command better valuations and, just as importantly, lower risk profiles.
The International Energy Agency, their 2025 outlook, had some striking numbers on critical minerals.
They did. They basically confirmed what we've been suspecting. There is a significant and growing demand for critical minerals through the end of the decade. As the world electrifies, the hunger for lithium, cobalt, copper, nickel, it's effectively insatiable.
And developed markets simply don't have enough of these resources.
That's the reality. Emerging markets control the vast majority of them.
But it goes beyond just digging things out of the ground. You mentioned agriculture, agritech.
Agritech is critical. Water scarcity is an operational reality in so many of these high-growth markets. So technologies that can manage water or improve crop yields, they aren't just green, they are essential for economic continuity.
If you can't secure your water supply, you can't run a factory or feed your workforce.
Exactly. It's that basic.
Now, these are very capital-intensive projects. Mines, water systems, they take years to build.
Yeah.
So how are investors managing that kind of long-term risk in markets that can be volatile?
They're using more sophisticated tools. We're seeing investors use carbon and biodiversity markets to hedge some of that risk. But I think the most important development is the rise of blended finance.
Blended finance, it's a term we hear a lot. Can you break down what that actually looks like in a deal?
In its simplest form, it's about a strategic partnership. You have development finance institutions, or DFIs, using public funds to mobilize much larger pools of private capital.
How do they do that?
They might provide a loan guarantee, or they might take a first loss position in a project's capital stack. This de-risks the investment for the private players who come in alongside them. It's often the only way to unlock scalable solutions for things like the UN Sustainable Development Goals.
So for an investor in 2026, DFI participation is a key signal.
It's a key signal of quality and security, absolutely.
Okay, so we have the state directing the economy, a massive digital backbone being built, and a rush for the resources to power it all. But we need to talk about where these goods are actually going. This brings us to Force 4, supply chain regionalization.
This is a huge one. We're seeing a clear move away from the hyper-globalized, just-in-time supply chains that dominated the last 2 decades.
And a move toward what?
Toward regional networks. It's a fundamental shift from prioritizing efficiency at all costs to prioritizing resilience.
So creating hubs that are closer to the end consumer, or maybe closer to more reliable trade partners.
Both. These regional hubs are boosting resilience across the board. Southeast Asia is probably the prime example.
What do we see there?
Between 2021 and 2024, we saw strong, sustained growth in manufacturing exports. And that was driven almost entirely by new trade deals and nearshoring companies moving production out of their single-source dependencies.
And it's not a trend that's limited to Asia.
No, not at all. We're seeing similar double-digit gains in manufacturing and logistics in parts of Latin America and Eastern Europe. These regions are really becoming the industrial workshops for their specific neighborhoods.
And it seems like trade pacts are the engine here. RCEP, the Regional Comprehensive Economic Partnership, is just massive.
It's enormous. It covers about 29% of all global trade. A pact like that lowers tariffs and harmonizes rules within the region, which just accelerates this whole hub-building process.
Now, for the listener who's thinking about the asset class here, we're not necessarily just talking about buying shipping stocks, are we?
No, not necessarily. This trend creates really interesting investable opportunities in the physical infrastructure of trade itself. Think automation, logistics parks, modern warehousing, and the associated real estate.
So if a region is becoming a manufacturing hub, the demand for modern, automated ports and warehouses just skyrockets.
It skyrockets, and that is a tangible asset play that is very distinct from traditional stock market exposure.
We've covered the what, the where, and the why. Now we have to address the how. How is all of this new infrastructure actually being funded? Traditional banks are facing their own constraints.
Which leads us directly to Force 5, the rise of private credit.
And this seems like maybe the most significant structural shift in the plumbing of the whole financial system.
I think it is. The numbers are just staggering. In 2024, non-bank financial intermediation reached $256.8 trillion US dollars.
Let's just repeat that, $256.8 trillion.
It represents about 51% of total global financial assets. So more than half of the world's financial assets are now held outside of the traditional banking system.
And in emerging markets, the gap that this capital needs to fill must be huge.
It is acute. In markets like Africa and Southeast Asia, credit penetration is still below 50% of GDP. That means there's a massive amount of economic activity that is just underfinanced.
And traditional banks can't fill that gap.
They're often constrained by regulatory capital requirements or just their own risk appetite. They can't always lend to those mid-sized growth companies that need the capital most.
So private capital steps in.
Exactly. We're seeing direct lending, mezzanine financing, and other forms of specialty credit filling that gap.
Can you touch on mezzanine financing quickly? It's kind of a hybrid, right?
It is, correct. It sits between senior debt and pure equity. It allows the company to borrow capital that might be convertible to ownership, or just carries a higher coupon. It's higher risk for the lender, but it offers a much higher return than a standard bank loan.
And it's vital for those SMEs and mid-sized businesses.
It's vital. They're the ones building the digital infrastructure and the supply chains we just discussed.
Now, one of the historic concerns with private credit has always been liquidity, the ability to get your money out.
That's changing as the market matures. Secondary transactions are becoming much more important for providing that liquidity. Investors are now actively buying and selling these loan portfolios, which creates a functioning market where there used to just be a long-term lockup.
So we've outlined these 5 forces: state-led investment, digital infrastructure, sustainable resources, supply chain regionalization, and the rise of private credit. It is very tempting to look at them as just a checklist.
But they are much more like an ecosystem.
They're interconnected.
You have to view them as an interconnected system. The state direction from Force 1 dictates the need for the digital infrastructure in Force 2. That new industrial base requires the sustainable resources from Force 3. All of that enables the regional supply chains in Force 4.
And the whole thing is funded by private credit, Force 5.
The entire mid-market layer executing this vision is funded by private credit. It's a self-reinforcing cycle.
Which is why success in 2026 is about more than just picking one trend.
It's about disciplined risk management. You can't just bet on one force in isolation anymore. You have to align with the structural trends of the entire system. If you're investing in a logistics hub, you need to know if it's powered by sustainable energy and if it's financed by stable long-term credit.
And that's where the complexity comes in. This isn't something you can easily navigate with a passive index fund.
No, this requires active structuring. This is what Delphos has spent over 30 years doing, structuring transactions to support this exact kind of capital mobilization and resilience. Whether it's capital raising or transaction advisory, the real value lies in understanding how all these dots connect before the market fully prices them in.
Before we sign off, I want to leave our listeners with something to consider. We've laid out how this landscape has shifted from a globalized, free market past to this much more regionalized, state-guided, digitally backed present.
It's a fundamental reassessment of where value is created.
So, as these five forces reshape the global landscape, is your current portfolio structured to capture the resilience of the emerging market regional hubs? Or is it still reliant on the fading models of the past?
That's really the question to ask in 2026.
This has been Delphos Insights. Learn more at delphos.co.